This is a project that closed in about 2015. This is a mental health services company that was formed about 10 or 12 years ago by, at that time, a 70-year-old, well-recognized, well-regarded mental health psychiatrist. And he knew that he was ill, and he knew that he wasn't going to be able to run the business forever. And he knew employee ownership at the outset. He knew that was his succession plan. That was the only way that the company would continue for its values to flourish, for its employees to stay with the company. He knew right at the outset that if the company were sold to a conglomerate or a financial buyer, that they would immediately erode and dismantle the very unique approach they had to providing intensive mental health services for schizophrenic individuals. And so he created a board that included employee ownership people who were involved in employee ownership. We started the process about 3 or 4 years into the company, and when we finally engaged in earnest, we had all company meetings. We had at least 3 of them where we sat 47 people down in a room and educated them and answered questions and began training employees on what it meant to become owners and on what the possible structures would be. We broke the employees down and allowed them to self-select into 3 functional committees: finance, governance and decision-making, and culture and values. And it was incredibly exciting to see them first learn. The finance committee had to first go through financial literacy training. They had to then review the actual financials of the company, ask questions, get comfortable, then make recommendations as to what they wanted to see differently if this company were to become employee-owned. The recommendations that came out of the Governance and Values Committee in particular were so exciting and innovative that at the time the board signed off and accepted them without exception. These were wonderful ideas, and it was exciting to see the workers take ownership over what the future of the business would look like. I raise this because it also had a really interesting employee ownership structure. This founder looked at ESOPs, looked at co-ops, looked at a variety of other options. The business at the time was an S Corp, a Colorado corporation, taxed as an S Corp, and we converted to a C Corp. We kept the corporate structure and restructured the corporate documents and rescinded the S election to become a C Corp with multiple classes of stock. The company functions like a co-op. It has one class of voting shares that cost the employees $100, and it has a Class B stock that is required for employees to purchase depending on their income. The more they earn, the higher their buy-in. The lower their salary or wage, the lower their buy-in. But that's non-voting stock. All the worker owners have the same vote like in a co-op, but they have to contribute varying amounts of capital depending on their income. They also sold non-voting preferred stock to investors and raised about $250,000 that helped finance the sale. We did the private offering to outside shareholders first. That money came in, and we used that to increase the balance sheet equity and allow for the seller to then start selling his stock back. We did it over 3 years. The seller sold 1/3 of his stock back to the company once a year at a predefined formula for valuation. We agreed on just book value, and we basically bought him out on 3 anniversaries at book value. Initially, there were 17 employee owners, 1/3 of the company elected to buy in. We made it available to any full or part-time worker. So out of 45, 1/3 bought in, and they did this a little differently. They have offering windows like an open enrollment period, and for a variety of reasons, we did it once. We have not. I'm back on their board, so that's why I say we. We haven't opened up a new offering, but we're about to. We just paid the first employee dividend. The preferred investors were so supportive, they waived their dividend, their preferred dividend. They waived it so that we could pay a dividend to the employees. Since the conversion, 3-4 years ago now, the company went through the death of the CEO, the founder. He died, left a gaping hole in the culture and hearts of the workers. The company went through its worst year in its history. It was unprofitable, cash flow was tight, and most of the workers in the company self-selected for to take a pay cut, to defer their pay. Actually, not to defer, to just to reduce their pay or forego a paycheck. And that helped the company get through that cash flow crunch. Since that time, the company rebounded to have its 2 best years in its history. And the board was so thankful that we paid full back pay, and we maintain wages above the kind of, not only above market, but above sustainable living for Boulder, Denver, which is quite an expensive community to live in. So the company's done better. We attribute the resilience of their financial condition to the fact that they're employee-owned. And some of those 9 have retired, some have left. In the process, the governing documents, make it very flexible for the company to determine when to pay out, redeem that employee stock. It is repurchased when an employee leaves, but at a minimum, the company only has to buy back the $100 voting share. The non-voting stock can be delayed and bought back later. The company has decided, we the board have decided generally to repurchase that stock within 6 months.
And you haven't invited new employees to join?
We have not yet invited new employees. We're going to reopen a new round probably in the next 6 months.
How many employees are there?
Still probably around 45 or 50. So this is another example that highlights choice of entity, and it highlights some tax considerations. This is a solar energy company. They design and build residential commercial solar systems. They operate in an area where profit margins on solar is really high. That's not the case everywhere, but their electric rates are through the roof, and so solar systems have really quick payoffs, and they're doing quite well. The company is about 12 years old. The founder, CEO, and his wife co-own the business, and they're in their early 50s, and they'd really like to take a vacation, enjoy time with their kids before they go to college, and not lose sleep endlessly running the business. So they started a conversation around employee ownership, and we learned that the state in which they operate has terrible co-op laws. You can form a co-op only for citrus production, agriculture, or for housing. It turns out the housing is for the elderly, and the ag co-ops are for the citrus growers. You can probably figure out where that is. And they have no other co-op. They can't form an employee or worker cooperative. It was important to them to be incorporated in the state in which they operate. They have electrical licenses, they have contracts, and they didn't need to, but they wanted to be incorporated. They could have chosen the co-op law of a different state, but they chose that they wanted to stay there. So we formed, the company also was a corporation taxed as an S-corp. And so what we did to kind of thread the needle for them was we formed an LLC, which elected to be taxed as a co-op under subchapter T as in Thomas. We'll talk about what that means. And the LLC acquired the stock of the old company. We did a stock transaction. So we drafted a cooperative operating agreement. Looks a lot like co-op bylaws, but it's an operating agreement for the LLC, which comports or aligns with the LLC law in that state. They have a 2-membership structure. Their 3 key initial owners have voting rights, but every employee is a member. All the other members are non-voting members. They're Class B members. The Class A members are the ones with voting rights. There's only 3 of them currently. 14 other people are non-voting members. The reason for making everyone a member is so that they can allocate their profit on the basis of patronage and deduct all of that profit under subchapter T. We'll again talk about what that means. But they created a pathway to go from Class B to Class A. So there's a very clear process, the number of hours and the duration, seniority for that candidacy period to be eligible to become a voting member. They have a board of directors or a board of managers. And in this case, yeah, question?
Did the voting members have a buy-in that the non-voting members didn't?
They did.
Okay.
Yeah, the voting members bought in for $10,000. The non-voting members, I think, had, it was either $100 or $1,000, which they could earn through payroll. They didn't actually have to put in the capital. This was an electrical contractor, really, and so they had electrical licenses, they had long-term contracts, they had a lease on a building, and to assign each and every one of those would have been a nightmare. It would have meant having to get a new electrical license, and it would have been a nightmare for the company operationally. And that's usually a good reason to consider a stock sale, where the assets of the business don't change hands, but rather the ownership of the old company changes hands. That's a stock sale. However, this company had significant capital gains. The owners started with nothing, and they were selling the company for nearly $2 million. That's tremendous capital gains exposure. And the buyers, the workers, to buy a $2 million business really needed depreciation expenses, which they could only get through an asset sale. So they had the needs for a stock sale, but they really wanted the tax benefits of an asset sale. And we're going to talk about this. There's this really underappreciated kind of unique part of the tax code called 338H10, which allows you to have the best of both worlds. And the local CPA didn't know about it, and I had to actually Google to find this, but it's available, and we'll talk about it because it's really exciting. I see the accountant, and suspect you're a lawyer. Yeah. I see you both really energized by that. So the benefit here is that the $2 million asset sale meant that the buyers, the workers, could take that $2 million and immediately offset their income with that depreciation expense. They could not do that holding just the stock, the paper. It also meant that the way they financed it, this was also 100% seller financed with a note, a 1-year note and a 5-year note. The seller was able to defer some capital gains or most of the capital gains because of the way that the asset allocation was structured. Some of the cap gains was due immediately, but that's another consideration for the CPAs. But this was kind of the magic middle, the 338H10.
So this is my example. Jason gave you a couple examples. This is the multi-stakeholder co-op that I mentioned previously. Colorado was the first state to legalize marijuana, and so now we have the first state that has a multi-stakeholder meditation co-op. It was started by a woman many years ago. Her name was Sierra, and she was the sole proprietor. She was formed as a S corporation, LLC, taxed as an S corporation. And she operated for several years, and she had a storefront operation that she leased the building. And she came to me wanting to convert to a co-op. She says, I really want my community to be involved in this organization, and so I want to be a co-op. So I said, do you know what a co-op is? And she said, no, but I know that's what I want to be. And I said, great. So I turned her on to a couple of books to read and a whole bunch of other literature. And she was one of those absolutely fantastic students, and she went away for 2 or 3 months and read these books and did her research. She'd call me every week or every 2 weeks and say, I have questions about this, I have questions about that. Can I do it this way? Can I do it that way? And over a period of time, she came up with a structure, and we came up with a structure where it was a multi-stakeholder co-op. Now, there were only 3 employees in this organization. That was it, 3 employees. But she had a group of vendors. She had teachers that taught yoga class, taught meditation. There were like 20 of them. They became a separate class of owners of the co-op. Then she had her customers. She really wanted the community to be involved. So she allowed the customers to become owners of the organization. And she split those up into 2 different levels of customer ownership. One is the just casual owner that comes in and buys a pillow or some incense or something, and you don't see him maybe once every 6 months. And then a heavy using owner of the co-op that's in there doing meditation every week and using the foot baths and the massage and the rest of it. And they pay a different price, they pay a different ownership fee, but they have voting rights. So the employees have voting rights, the vendors have voting rights, and this one class of ownership of customer has voting rights. And it's worked out really well. She went from a 1 person to over 1,200 members in 3 years. Huge. Now, of this 1,200, I would guess the majority of them are the little $10 a year owners that only come in and buy a pillow once in a while. You've got your 3 employees. I think there's 20 vendor members, and about 200 of the really solid consumer members. Her membership meetings are a blast to attend. They are very excited. She went through a fundraising campaign this last month about getting more funding for a meditation garden next to the building. And so they've started construction on this meditation garden. Everybody in this whole area of town knows this co-op because half of them are members of the co-op. So it's just another example of how a multi-stakeholder with these various groups can be used as a co-op.
Around the corner from that is our office in Denver, which is a desk in a co-working co-op. Wayfinder co-op. So we talk about that in communities like this that have transitioning building frontage, and we look at some of these spaces, and this was in a converted industrial building in West Denver, and it's for outdoor recreation companies. There are about 20 members that became a co-op, got the master lease, spent about $500,000 redeveloping it, and we, the co-op, are the tenant. Just last month, we got a tap room license, and so now we own a bar. And it's been profitable since day one, and our rent is below market, and on top of that, we're likely to see a dividend of about a month's rent at the end of the year.
What's the name of it?
Wayfinder Co-op. It's a limited co-op association, but it's a multi-stakeholder co-op. The founders are members, we, the tenants, are members. They have drop-in members, and then there's an investor member class as well. So this multi-stakeholder model is really catching on. It's really adaptable for worker ownership and beyond.